income from house property. When an individual lets out his property, the rent received becomes taxable. Normally, house property has the following options: self residence or self business. For that, no rent, so no income. Second option, let out for residence or let out for business. There is rental income. The major terms to be covered while computing income from house property. First one is municipal valuation. What is municipal value? It is value fixed by the government based on the government guideline value of the property. It may differ from place to place. Second one, fair rental value. Based on the market value of the neighborhood property, it is called market value of the property and used to determine the expected rental value of the property. Next one is standard rent. It is a rent value fixed under the Rent Control Act of 1961 and used to determine the value of expected rental value of the house property. Fourth one is municipal tax or local tax. It is a tax levied by the local municipality or panchayat. Normally, 10% of the municipal value be collected by local authorities twice in a year. Let we see the tax treatment of the let out property. First one, municipal value or fair rental value. Out of these two, whichever is higher? We have to compare standard rent with that value. Whichever is least, that value is called expected rental value. It is part 1. When the property let out to others, annual rent, not actual rent, please mind here, annual rent, less garden, lift, water and sewerage maintenance charges and unrealized rent. When rule 4 must satisfied for unrealized rent, we have to deduct these expenses. The property which is let out, this amount will be deducted from the annual rent. So the balance value is called the real rent. Now we have to compare the expected rental value or the real rent, whichever is higher. That value is called annual rental value. In that value, we have to deduct vacancy allowance. When the property is vacant 1 or 2 months during our previous year, we have to deduct vacancy allowance from annual rental value. So the balance value is called gross annual value, GAV. In that, less municipal tax paid by owner. Actually paid, no outstanding is allowed. When the municipal tax paid by the tenant, that is not also allowed. Only municipal tax paid by the owner is allowed to deduct from gross annual value. Balance value is called net annual value. In this Income Tax Act permitted less deduction under section 24 subsection 1, standard deduction at 30% of the net annual value. Second one, interest on loan. When loan taken for the purpose of purchase or construction or repairs or renewal of the property, the actual interest paid plus outstanding interest thereon is also permitted to deduct under section 24 subsection 1. So the balance value is called income from let out house property. Shall we see one practice? Practice 1. From the following information, calculate gross annual value of the house property. Actually, in this problem, no information about annual rent. Municipal value is given, fair rental value is given, standard rent is given. It is the basic. Let we see the solution. Step 1. Consider municipal value or fair rental value, whichever is higher. Municipal value 4 lakh 40 and fair rental value 4 lakh 20. Whichever is higher, 4 lakh 40. Step 2. Compare that value with the standard rent and select whichever is least is called expected rental value. The standard rent is only 4 lakh 25,000. So 4 lakh 40 or 425. So 4,25,000 is the least value that will be considered as an annual rent. So that value is called gross annual value of the house property. In the same pattern, the listeners can practice exercise 1A for house 1, house 2, house 3, house 4, house 5 for their clear understanding. Let we see practice 2. Compute the gross annual value. House 1, house 2. Municipal value is given, fair rental value is given, standard rent is given, annual rent because these two properties were let out. For the first house, 1,44,000 means the first house let out for 12,000 per month. And the second house, annual rent is 2,40,000 means that property was let out at 20,000 per month. And unrealized rent. What is unrealized rent? The house property was let out to others, but the owner of the property not able to collect the rent from the tenant properly. That is called unrealized rent. Here, Rule 4 of the IT Act 1961 must satisfy. Actually, unrealized rent must be the default of the tenant, but there will be no any question in the hands of the house owner. As a house owner, I don't find any time to collect rent means that will not be accounted as unrealized rent. As a house owner, you have to collect rent from the tenant. Okay. Now see the answer. Municipal value for the first house 1,40,000, second house 2,25,000. Fair rental value for the first house 1,30,000, 2,60,000. Whichever is higher. For the first house 1,40,000, for the second house 2,60,000. We have to compare that value with the standard rent. For the first house 1,25,000, for the second house 2,50,000. Whichever is the least. So the expected rental value for the house 1 is 1,25,000 and for the house 2 is 2,50,000. With this value, we have to compare the annual rent. Annual rent 1,44,000 for the first house. In that 12,000 is unrealized rent. The owner of the property not able to collect the rent from the tenant. It is a default committed by tenant. In that situation only it was permitted under Rule 4. So 1,44,000 minus 12,000 balance 1,30,000 is the real rent for the first house. In the same case, for the annual rent 2,40,000 but unrealized rent is 20,000. Balance 2,20,000 is the real rent for the second house. Out of these two, whichever is higher, that value is called annual rental value. So for the first house 1,32,000, for the second house 2,50,000. But in this sum, no information about the vacancy allowance. If there is any vacancy allowance, that should be deducted from the annual rental value. So annual rental value minus vacancy allowance, that is called gross annual value. But in this sum, no information about the annual value. So the listeners, in the same pattern, you can practice exercise 2 and verify the answer. Now let me see for practice 3. Compute gross annual value from the particulars given below. House 1, house 2. Municipal value given, fair rental value given, standard rent given, annual rent also given, unrealized rent also given, and lift maintenance charges, water and pump maintenance charges, garden and maintenance charges, the property which is let out, the property's other maintenance expenses are given. How to compute the gross annual value? Let me see the answer. For the first house, municipal value 1,40,000 and for the second house 2,25,000. Fair rental value for the first house 1,30,000 and for the second house 2,30,000, whichever is higher. So the 1,40,000 and 2,60,000. First step we have to take this one. With that value, we have to compare the standard rent for the first house 1,25,000, for the second house 2,50,000. So the expected rental value is 1,25,000 for the first house, 2,50,000 for the second house. With that value, we have to compare the annual rent less unrealized rent and other maintenance expenses of the let out property. Actually, I showed here only for the first house. In the same pattern, you have to calculate for the second house. Annual rent is 12,000 per month, so 1,44,000 less unrealized rent. If any information about unrealized rent, that's rule 4 is satisfied, means there is no any default of the house owner. So that should be deducted from the annual rent, and all other maintenance costs will be deducted from the annual rent. So the balance value is called real rent. Now we have to compare the expected rental value or the real rent, whichever is higher. That value is called annual rental value. In that annual rental value, we have to deduct vacancy allowance. If the let out property is vacant is 1 or 2 months, that is permitted under IT Act. So we can deduct that vacancy allowance only from the annual rental value. So the balance value is called gross annual value. It is the basic steps of the income tax listeners, students. In the same pattern, the listeners can practice exercise 3. Now shall we go for practice 4? Compute gross annual value from the particulars given below. House 1, house 2, municipal value is given, fair rental value is given, standard rent is given, annual rent is given, unrealized rent is given. Rule 4 is satisfied, so we can deduct this unrealized rent from the annual rent. Other maintenance costs are also given, and finally vacancy allowance also given. So the first house is vacant for 2 months. Out of 12 months, only 10 months only this property was let out. And property 2, house 2 is vacant for 1 month. Out of 12 months, only 11 months only let out. So, how to compute the gross annual value? Let me see the answer. Municipal value for the first house 1,40,000 and 225 for the second house. Fair rental value 1,50,000 and 2,60,000. We have to choose whichever is higher. 150, 260. With that value, we have to compare the standard rent. For the first house, 1,25,000. For the second house, 2,50,000. Whichever is least, that value is called expected rental value. With that value, we have to compare the annual rent less unrealized rent. When rule 4 satisfied, we can deduct it. Actually, I shown here only for the first house. In the same pattern, the listeners can calculate for the second house. Unrealized rent 12,000, lift maintenance 6,000, water pump maintenance 2,000, and garden maintenance 4,000 for the first house. We have to deduct it. Balance is the real rent. Now we have to compare the expected rental value and the real rent. Whichever is higher, that value is called annual rental value. In that value, we have to deduct vacancy allowance. In case of first house, it was vacant for 2 months. What is the annual rent? 1,80,000. 1,80,000 by 12. So 15,000 is a monthly rent. Into 2 months is vacant, so 15,000 in 2 months, 30,000 we have to deduct here for the first house. And for the second house, annual rent is 2,40,000 by 12, so 20,000 is per month. That 20,000 we have to deduct here. So the balance value is called gross annual value. In the same pattern, the listeners can practice exercise 4 and verify their answers. Now let me see for practice 5. Compute the taxable income from house property. Municipal value given, fair rental value given, standard rent given, rent received. April to June, first 3 months, the rent is 36,000 per month. From July to March, it was increased, 48,000 per month. Municipal tax and insurance premium is given. Let me see the answer. Municipal value 4,80,000, standard rent 5,04,000, fair rent 5,04,000 and standard rent 5,40,000, whichever first municipal value, fair rent value, whichever is higher, 5,04,000, and standard rent expected value 5,04,000. Here we have to compare the rent received, annual rent for the first 3 months. 36,000 into 3, 1,08,000. Balance 9 months, 48,000, 9 months, 4,30,000. Less unrealized rent, etc. etc. means all the maintenance cost of the property. So 5,40,000. Out of these two, whichever is higher, that one is called annual rental value. Here we have to deduct vacancy allowance. In this problem, no vacancy allowance. The balance value is gross annual value. In this gross annual value, we can deduct municipal tax paid by the owner, 48,000 per month. So balance value is called net annual value. Here we can deduction under section 24 class 1, standard deduction up to 30% of the net annual value, which is permitted by IT provision. So 4,92,000 to 30%. Any interest on loan, but in this problem, no any information about interest on loan. So balance values taxable income from house property. In the same pattern, the listeners can practice exercise 5. Now let me see practice 6. Compute taxable income from house property from the particulars given below. House 1, house 2, municipal value, fair rental value, standard rent, annual rent, unrealized rent. Rule 4, not satisfied. That means we cannot deduct unrealized rent from the annual rent in this problem. But the lift maintenance charges, water and pump and garden maintenance, we can deduct from the annual rent. Vacancy allowance also given in this problem. And municipal tax paid by owner, which is permitted to deduct. And the municipal tax paid by tenant, it is not permitted. So please check up this answer, how we prepare the completion of tax income of house property. House 1, house 2, actually both these house properties were let out. Municipal value 2,40,000 and 325 for the first house. Second one, fair rental value 2,50,000 and 2,60,000, whichever is higher, 2,50,000 and 325. With that value, we have to compare the standard rent 2,25,000 and 2,50,000. Whichever is the least, that value is called expected rental value. For the first house, 225, for the second house, 2,50,000. In that value, we have to compare the annual rent less unrealized rent, but rule 4 was not satisfied, so the amount will not be allowed to deduct. Other the maintenance expenses, the lift maintenance, water and pump maintenance, garden, we can deduct. Actually, I showed here only for the first house. In the same pattern, you allowed for the second house. So the real rent for the first house is 2,25,000. For the second house, 2,86,000. Whichever is higher, that value is called annual rental value. For the house 1, 2,27,000. For the house 2, 2,86,000. Here we can deduct vacancy allowance. House 1 is vacant for 2 months. Annual rent is 2,40,000. So by 12, 20,000 into 2, 40,000 is a vacancy allowance for house 1. In the same pattern, annual rent for the house 2 is 3 lakh. So monthly rent will be 3 lakh by 12, 25,000 into 1 month. 25,000 is a vacancy allowance. So balance is called gross annual value. In that gross annual value, we can deduct municipal tax paid by the owner. For the first house, municipal tax paid by the owner 14,000. For the second house paid by the tenant, that should be ignored, that should be accounted. So only 14,000 only we can deduct from the house 1. So the balance value is called net annual value. In this we can deduct under section 24 subsection 1 standard deduction. In this 1,73,000 we can permitted 30% of the net annual value. But in this problem, no information about the interest on loan. It is a basic problems of the let out properties only. In the same pattern, the listeners can practice exercise 6. Actually, these 6 problems were covered only to understand the basic concepts of the layout properties. In the next video, we'll see the advanced properties. Okay, bye.